All right, so sometimes I feel like here in the state of Utah, we're always kind of waiting for the next big earthquake, the big one to come, because we live right on the fault and we haven't had this big earthquake in however many thousands of years or whatever. But it also feels like that way in the stock market. Every time there's a down day, like, oh, we know that there is an exhale coming. Is this it? Is Thursday and Friday, that weakness on Thursday and Friday, noise, or is it more than that? Is it a tremor that might lead to the big one? If you could call an intermediate pullback the big one. But so I'm going to break that down today and see how bearish this selling was, what drove it, and what we can expect to see going into next week. Whether or not we can expect a little bit more bullishness here, or today was kind of a false flag, the last 2 days a false flag, or is it a red flag? Is it a sign that, oh, this next week, here we go, like we're really starting to pick up steam? So I'm going to break that down. I'm going to break down the stock that does have a pretty ominous looking chart itself on it, and see if we might be able to use it in any kind of market environment for a hedge type of trade. So I'm going to show you how to do that. And let's go ahead and get started. Today is Friday, January the 15th, 2021. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. 2 down days to finish the week, but again, still easily above the 30-day moving average. The intermediate line dropping below its market sentiment, but still in the upper reversal zone. So we still have dark green shading. It's a strong bullish posture, strong market sentiment, bullish market sentiment. The near-term line did drop as we thought it would. Like we, kind of thought we were, closer to this the end of this near-term run. The momentum line gave us an intermediate confirmation signal on Friday, but obviously the near-term line was probably closer to dropping than it was to bouncing, and now it is below the lower half of the chart. So now we're probably set up to bounce off of this, bounce back up, and potentially have another near-term run. In fact, I think we'll probably get another near-term run or two out of this. Now, of course, I could be wrong on that, but now I don't know if the next couple of near-term runs will last as long as we've had them. This one lasted pretty much 1, 2, 3, 4, 5, 6, 7 days, and then the 8th day we fall. So 7 to 12 is your typical time frame. Over here, we were 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 10, 11, 10 days before we dropped on day 11. So that's just kind of how, like, that the 7 to 12 day. I mean, that was a typical run. That was a typical run. That was a typical near-term run. Little atypical, little bit of a short bounce there. But now I think we'll probably get about 3 to 4 day, maybe a couple of them before this intermediate run is over. Usually you tend, when you get to long near-term rallies, you either kind of go parabolic with a big run, or you start to really shorten up. Like this would have been kind of the normal end of intermediate run near-term rally, where you only go for a few days and the near-term line doesn't get very high, and we might get 1 or 2 of those kind of runs as we kind of peter out and these moving averages start converging with each other. When we look at the 8 and the 17 day, right, when they start converging with each other, that's when you'll see that. You can see the NASDAQ or the Russell not nearly as bearish as the S&P, so that's why I'm not so bearish. Like, I'm not thinking like, here we go, we're going to be tanking here. Obviously, remember, as I told you before, anything between 0 and 23% is noise, right? Anything between 0 and 23% is noise. So keep that in mind. You look at the NASDAQ composite here, and you can see, again, we're easily, we have light pink shading, and that's, that's weakly bearish, and the near-term line is down. But again, it's just noise because we're between 0 and 23%. We haven't dropped below that 23% line, and we're not anywhere close to dropping below it on the Russell, which is where we would expect more weakness to be once an intermediate decline actually starts. We expect. I mean, look how like these intermediate Fibonacci lines are lining up right on top of these long-term lines. From the COVID low point, the market sentiment low point that we've been on here. We've had this one intermediate decline there, and that's been it. We've had a good long-term intermediate run there. We've had a good intermediate run here. Even though we did get dark pink shading for a few days, we didn't get it, with a red line, and that's about as weak as one as we got. And then we've rallied up, and this was just not very much of a, if you can see, when we were right over here, I guess this would be our high. I mean, we hit the 23% and briefly got below it. And then that ended up being the low point. So that was about as much of an intermediate pullback as we got. Over here, you can see, we did get below the 23% line, but we didn't get, below the 30-day moving average significantly. And we bounced right back up and kept going. So that was about as weak of an intermediate pullback as you could possibly have. And then we've continued higher. But it's this leg that we've continued higher that's really caught the Russell up with this underperformance that it's had against the Qs for weeks and weeks and weeks, all the way through the COVID low point and then subsequent bounce. This is where it really lately, especially off of this low point, but really coming off of this September 24th, this is where the Russell's outperformance has really started to take off. You see that here in the relative strength chart, right? So here is that September time frame, and there's that end of September. That's the last leg higher. Since then, the Qs have been underperforming against the Russell 2000. You can see the MACD trying to diverge here on the line. You can see the we've been below 40, easily below 40 on the RSI, but we're not really getting to extreme lows. And you can see the PPO. This is actually the long-term PPO, so I'd have to move this to a weekly chart. Let's go weekly and go 5 years here. You can see the weekly PPO is still negative, and your histogram is pretty low right now, and we are still pointing lower. But I think we're going to be working on finding a low point here around these Fibonacci levels that really kind of took off. If I were to draw Fibonacci lines on this from here to here, from 110, maybe a little bit below 110, all the way up to this 118.75 area, this time frame. We're looking at right about the 50%, maybe 38% Fibonacci retracement line, where we're sitting here at about 1.5. So good chance that we find some support in this area. And the histogram, then most of the decline is momentum has occurred, and it appears that momentum starting to slow down a little bit, even with a down week that pretty much only filled in the lower shadow, traded in the range of the lower shadow of last week's. And again, this is a relative strength that actually didn't trade, so this is the relative strength of those two ETFs. Okay, since it is the end of the week, let's take a look at the weekly market forecast, and you can see the Russell getting a cluster, another overbought cluster. This time, that was a really bullish overbought cluster because you just started the intermediate run. This one now, we're even that much higher and that much more bullish. You can see when you look at this chart of how far up the Russell is above its 200-day moving average, it's 35% above its 200-day moving average. That is double what the NASDAQ is above its 200-day moving average. And the NASDAQ kind of went parabolic there at the end of August when we got over 30%. And the S&P was right about the same time frame as well. But we are, needless to say, the S&P is up 14%. That's about where it got to here in July or January of 2018. We were right in this area. You go back to the 11th, February 11th, and that was about the peak. And you can see we were up here for a while, coming off of that low point. We were strongly above, not even more close to 35% above on IWM. So IWM has really kind of gone, parabolic mode here off of this, really off of that September. I mean, just at the low of that September, the Russell 2000 was at its 200-day moving average. The NASDAQ was 13% above it. The S&P was 4% above it. The Russell was actually just a day below it, just a 0.75% below the 200-day. So the Russell went from this extreme underperformance to whoa, more than doubling percentage basis above its 200-day moving average and what the NASDAQ is. So when I see overbought clusters at the beginning of an intermediate run, that's pretty bullish, right? That means that we've got a good trend change. We've got the opportunity for a good trend in the other direction, especially breaking through the pre-COVID highs on that week. Since then, now we've gone this parabolic move, 35% above the 200-day moving average. You get an overbought cluster. Now it's a little bit more concerning, and I've shown you linear regression in the past too. especially when you go out 20 years. We'll go out to a monthly chart here. Let's actually do a weekly chart so we can get a little bit more. So give you some perspective there. The S&P 500 obviously easily above, but there's the Russell 2000 also 2 standard deviations away from its median. With again an overbought cluster on that week. So that's the kind of concern here about. Again, it doesn't mean that we're going to tank next week. It just means that I'm not too worried about upside risks here. If we do continue up, it's going to be very, very slow. You see the S&P is what I wanted to show you on the weekly chart. So let's go to a weekly chart here. And you can see after getting 2 consecutive clusters, a little bit more of an inside week this week. Lower shadow, remember, can be bearish. And the near-term line has not had the near-term pullback. See, the near-term pullback on the weekly chart ends up more often than not being a intermediate pullback on the daily chart, and that's what ended up happening here. And we've had multiple, pretty long, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks now of this near-term rally. That's a pretty good, on the weekly chart, that's a pretty good length of time. So I think, again, I don't know if it's next week. I think we might get maybe another near-term run or 2 of exhaustion on this intermediate run before we get this. But it could start, again, it could easily start as early as next week with on the weekly chart, this moving down to the downside. Because you remember, if you look at the monthly chart on the market forecast, the month of December ended with a cluster, right? So we ended with a cluster there. And when you look at the same thing here on the Russell 2000 and how we ended December, we didn't quite get a cluster on it, but we came really darn close to getting a cluster. And you can see the kind of move we're getting here, this kind of 3-month just extreme move to the upside. To get that far away from the moving average, as you can see over here, it doesn't mean we have to drop to it, but it just limits the upside anymore. And at best, we kind of grind a little up slowly. So this is a monthly chart, mind you, and we just and the moving average catches up that way. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know that you liked our video today and you want us to do another video again tomorrow. It's a quick way to give us feedback. If you don't like our videos, you don't have to click on anything. You don't even have to watch. But if you like our videos and you want to let us know, we really appreciate it when you click that thumbs up down there. Also comment, what did you get out of our video? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there on the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right here at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, I invite you to check out again some of these things over here on the right, our schedule of upcoming classes, as well as our Market Outlook live videos. Of course, you can subscribe to our monthly plan to get access to all of our trading rooms and our Market Outlook live videos here. There's a link that takes you there. Our premium plan, which gives you access for 3 years, includes all of that, plus our premium tools and our Q&A sessions and access to our community, our class forums, where we have custom content and conversations there. Come down here, click on this heart. It opens up this window. Hit this like button right there. Also hit this thumbs up icon on the Facebook post. It opens up another new tab. Hit that thumbs up icon there. Again, the more you do that, it benefits us because our content will get to more of our followers, because Twitter and Facebook will promote content to our followers that has a lot of engagements, a lot of likes and comments and retweets. It benefits you because they promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, let's get back to the charts here, and let's see. You can see that we did get a higher high, and we did not get a lower shadow by the end of the week, but we did not get a higher close. We did get a higher close. We did not get a higher high. That was the only thing, missing. In fact, we came pretty darn close, 38.26 to 38.23. So it's about as close as you could get. And of course, the momentum, as high as it is, the gap between the 50 and the 200-day moving average, as high as it is, we're kind of, we're getting bigger in both directions. We're getting bigger. Again, I don't think we'll get a big move to the downside. I think we'll start to slow this down and grind our way to the downside, which is typical. But like here, we're grinding our way to the downside there. When we got really high momentum, then we started to at least make a run towards that 200-day moving average, which, as we talked about before, by the time, if we were to start that, by the time, just by, I drew this line here, by the time we get to mid-February, looks like February 17th, in this area, or February 8th, and that the week of February the 8th, that's when the 200-day moving average will most likely get to that 23% retracement. So we could come down to the 23% retracement level like we did there and not have an intermediate pullback, but not be a long-term move. It'll just come to the 200-day moving average, bounce, and then work our way back up towards what I would expect to be a new higher high eventually by the end of the year, but not a new higher high on the PPO. So there'd be a divergence, and we probably continue to grind throughout 2022 into the early part of 2022 by the time we now start to get towards those midterm elections by then. Let's take a look at the 3 green arrow chart, and you'll notice right here, you'll notice here we do have a red arrow again, a decent amount of volume, a red arrow, but only one red arrow. So if you look at the stochastics, excuse me, not this chart, if you look at the stochastics, you notice it did cross below its moving average, but it's still above 80, so not a red arrow there yet. We did cross below the moving average of the MACD2, and we did, so that gives us the red arrow there. We're still above the 17-day moving average. So remember, until you cross below that, there's not even, remember, we don't cross, until we cross below this 23% level, there's no intermediate pullback. Until you cross that 17-day moving average, you don't even have to worry about an intermediate pullback. So keep that in mind. As bearish as we were the last couple of days, all we've done is come to the 17-day moving average and nothing more than that. Like I said before, I think I will probably get another near-term run or two out of this, small grinding ones before we finally wrap things up here. As I mentioned too, when you look at that 23% line and see all that volume that's down there, that's why it won't be easy to break. Right? It'll be, it's going to be a little. We're still in the upper half of the chart. We haven't even broken the midway point of the Bollinger Bandwidth this entire time, this entire intermediate run here. So you kind of have to get that first. As you can see, we got to get below that 50% mark before we start even considering the beginnings of an intermediate pullback. And while we're down towards the 20-day moving average here, which is the midpoint of this run, 20-day exponential moving average, we're not through it yet. All right, when you look at the intraday move, you can see the gap to the downside, and now I would not consider that a significant, like a runaway gap, like we're starting a bearish intermediate run now, right? It was not a significant gap down here. We didn't have a significant close to the downside. There still is a pretty large gap between the implied volatility and historical. So that type of move is coming, but it didn't start Friday. A lot of people might think it did because they're not used to markets ever going down. But this was not that's a common gap. So you would expect it to get filled. I did mention to you on Wednesday that breaking through that, and Monday for that matter, that breaking through that volume, there's nothing below us. So how easy it is to go down, and that's kind of where we're at right now. We can fill in that gap and hit that as resistance now on the upside and still fill in this gap down towards 371. And of course, 23% retracement level where the intermediate run would start, or pullback would start, would mean that we're breaking through that volume node and in a couple of days, most likely breaking through the 4-week low point, because that's going to move up to this range by the time we get done. By the time we hit the end of next week. Now let's look at the volatility. You saw the volume was pretty large, and the range, including the gap, was relatively large too. But the volatility itself, while it did ramp up to close to 24 again, we are still in bullish territory, so we're below 90%. So, as high as it is on an absolute basis, it is still relatively low on a relative basis. So, again, until we break up to 105%, this was such the anomaly to get a break to 105% at the end of an intermediate run rather than the beginning. It's more often than not that we get that type of move early on, and like I said, we're not anywhere close to that. We are starting to ramp up a little bit. Usually those types of moves occur after we start getting smaller and smaller ranges. So we did get a relatively big range here, 4 points, but that's down from 7. And so, again, 3.3, 5.04, 4.45. So we are starting to tighten up. And the more that range tightens up, and I think, again, another week or two of really small ranges on the VIX towards 20. So another near-term run or two to the upside will tighten up that range, and then we'll get that type of 1 week spike that will get us up to the 105% mark, most likely. And then that will be the beginnings, right, of the intermediate pullback, where now we will probably stay in the lower end of that, towards Fibonacci support for a month or two before we build a bottom, bounce off of it, get going with new intermediate run at that point. All right, so before we look at some other charts here again and talk about what's driving this price action, let's just talk about just review my technical outlook here. So the trend is obviously still bullish. We are overbought. That continues to be the case. But you notice our up days are not really like taking off. We're just grinding up. So we're getting kind of smaller up days, and we know what our risk is to the downside. And that's out there, and it's getting closer. I still think we have maybe another quick little near-term run or two up with limited upside. I don't think we're going to parabolic move close, to where we parabolic and then drop off. I think it'll just be kind of one or two grinding near-term rallies, maybe to higher highs, maybe but just smaller moves to the upside before we finally start to get that exhale and that expected pop in volatility. It might take another week, maybe two, before that type of move sets up here. But we are getting a lot closer according to a lot of the indicators that we saw there on the chart. So what do you think? Do you agree with that? Do you disagree? Comment down below, especially if you disagree. What charts or indicators are you looking at that suggest why you're a lot more bullish or a lot more bearish than I am right now? All right, now let's talk about what's driving the price action today. And you can see the turnaround. In fact, let's take a look, and just in the last couple of days, remember. Let's take a look at how the week performed here. So we'll start off here on the 11th and work our way through the end of the week. And so again, you can see small cap stocks had a really good run early on. We're up 3% at one point for the week. So kind of a little bit of a parabolic move. And the Russell 2000 finished 1.5% higher. The Qs, on the other hand, 2.25% lower. So a dramatic difference in those different U.S. equity asset classes. On the other hand, you can see how the dollar had a really strong week and put pressure on, and not so much commodities. It did bring commodities back down on Friday because that's where one of the biggest dollar moves was. The early dollar move on Monday did put pressure on both commodities, but as the dollar fell, commodities rallied midweek, and then another jump in the dollar at the end of the week put pressure on commodities, and gold ended up down 1.25% as a result of that. So let's take a look at what that dollar looks like here and how that move looked like today. So let me bring up this chart here, and we'll take a look at the Euro US dollar. And you can see sitting right on that 38% retracement level, dark pink shading in a red line. So we are we've broken through that 23% retracement level. We've broken through the 23% retracement. We've got the dark pink shading in the red line. We are well below the 30-day moving average. We are in intermediate pullback mode. There is some support here. I do think we're probably more than likely going to go through the Fibonacci retracement zone to the next layer of support down to that 62% by the time all is said and done. But even if we hold here, that doesn't mean we have to take back off from here. We can stay between the 23% retracement and the 38% retracement for a little while. In fact, we might make a little bit of a retest move up to the moving average, which by then would be below the 23%, and then make our way back towards the 50% or lower retracement levels. So you can see the dollar is making a run right now, and that's having an impact on things like TLT, which has hit a low point this week with the overbought cluster, last week with the overbought cluster, seems to be finding a low point and trying to work its way back up to the upside. You look at commodities, and you can see commodities have, they're overbought. We came really close to clusters here by the end of the week. We're well above the 30-day moving average. There's opportunity for a weak dollar, or a strengthening dollar, to put some pressure on this just for an intermediate pullback and nothing more than that. And then you take a look at gold. Let's look at the futures contract for gold. And again, dark pink shading and a red line. That strengthening dollar more than likely means that gold will make a run towards 1700 through the Fibonacci retracement zone down to 62. I don't have to worry about a long-term bearish trend until we break 1600. That 78% line. But we're not going to get a resumption of the bullish move, which I fully expect us to get, even with a bullish market, until we break above 1940. Because again, remember, a weakened dollar pushes stock prices higher, but it also pushes gold higher. It just doesn't push gold higher than stock. So it will be a lagging asset class. It just won't be going down. Right? A lot of times we just think everything is on an absolute. It's everything is up or everything is down. It's like, no, if dollar's down, then stocks will go up, which is great, bullish. Gold will go up too, which is not typically what you think for bullish, but it just won't go up as much as stocks. So I get that question. So is gold going to be bullish if the markets are bullish? And the answer is yes, but that doesn't necessarily mean you want to buy it, because if gold's bullish and stocks are bullish and risk assets are bullish, you're going to get a much better return in those risk assets, and you're going to give up a lot of return opportunity cost wise if you were to stay in gold simply because the dollar is dropping. All right, now let's take a look at how these sectors are performing. So let me go to just this week that was. Go to a 10-minute chart here. All right, so you can see energy started off the week really strong, hence why small caps were doing so well, and they ended up 3%. On the other hand, look at communication services down all week long on these social media companies and Google, all just struggling. XLK finished the week down with a couple of down days on Thursday and Friday. XLY finished down along with XLP, so all consumer stocks down there. And then real estate and utilities ended up the week strong. Financials started strong, and industrials, they lagged and ended up with small losses, small gains, whereas these safe haven areas. So you can see a relatively safe haven week, the beginnings of this. And if you go back to about, last couple of weeks here, when you look at here, let's take a look at, let's see this one. Nope, let's go here. So when you go back to this last couple of weeks after we kind of popped up there, and really from the beginning of the year on. So let's look at the beginning of the year on here. So it'd be January the 1st, actually be the 4th. So you can see materials, energy, financials really doing well, consumer discretionary really doing well, healthcare. But again, this XLK, XLC down year to date so far. XLU and XLU and real estate were kind of lagging behind, and so it hasn't been this has been a relatively parabolic move in some of these sectors. The energy sector up as much as it was, financial sector up as much as it was. So it wasn't a complete parabolic move there, but about as close as you could possibly get. This is what XLE looks like on its own chart, getting a cluster during the week, not by the end of the week, before starting the rolling over. Remember, by the beginning of the year, it had been down and bouncing up. And then you look at XLF, and XLF is diverging to the upside here with a lot of its indicators having such a good run for so long, but of a lot of its indicators starting to roll over. And you can see on the RSI and the CCI, you can see how big, again, you get these types of RSI, you get these big moves at the very end, like when you've gone parabolic, you get these big runs up above 70. It's so rare just to get above 70 as it is. When you've been above it for so long and you spike up on the CCI and we start to roll over, again, just kind of keep an eye. Those sectors, XLE, XLF, XLI, will be the first ones, and the ones I'll probably drop the most. You can see XLI starting to roll over to the lower half of their charts there, and you can also see too on its two-line versions the weakness we're seeing below the 17-day moving average, and the MACD and stochastics rolling over from these divergent high points. So again, those sectors show weakness, they're going to be the ones that drop the most. And then you'll see some weakness in the QQQ2, but it will be relative, won't be as much as what we'll see in these. And then those will be the sectors, XLK, XLC, those will be the sectors eventually that will work their way back up to the upside and outperform when we take off again. Right now, XLK, light pink shading the yellow line, it's a bullish pattern. XLC, dark pink shading in a red line, we're bearish there. XLY is way above its moving average and rolling down along with XLB and XLF and energy and healthcare. Staples, along with communication services, dark pink shading in a red line, and some of these real estate and utilities starting to show some emerging bullish trends. So you can kind of see how the market's shifting to a little bit more bearish than it has been towards some of these lagging safe haven interest rate sensitive sectors. All right, so for our trade idea of the day, I did want to take a look at UPS. And UPS is kind of showing a little bit of some breakdown too. This is kind of the pattern I told you about before in the markets, right? Or on the Euro US dollar, excuse me. We broke down below the moving average, got some clusters here in fact, bounced up towards the moving average, and now looks like we're rolling back down. We do have light green shading, but we're below that dark line. But what really kind of stands out to me here on UPS is we are moving into an area where there just is a very little volume support. I mean, look at that. We break this level down here, it's going to be very easy to drop. Now, will we drop to 100 again? I don't know. I highly doubt it. But there is just very, very little volume support here. Very easy for it because we went up so far. Like most of this gain, occurred. We were kind of grinding here, moving away kind of nice at 120. And the earnings came out and boom, we were up to 160 just like that. Like we went from 120 to 160 with very little volume. And then we just kind of stayed here and built up a lot of support that it appears that we're testing right now with some kind of head and shoulders pattern here with the ability from 160 up to 180 to drop down to 140, right? If not below that, at least down to this area here just below 140 where this gap up is down there. And you can see, from a lot of these other indicators that are starting to show weakness too. Back below 40, we bounced at 0 and stayed down. You look at its directional movement index here, and you can see popping up above 25, back below 20 on the negative index. The ADX is still below 20, so there's an opportunity for this type of move to occur here, a trending move to occur. You can see on the Ichimoku cloud, we don't have it. We're getting the beginnings of a bearish move. We're below the cloud. The green line is below the blue line. The price is below both. So you can kind of see the emergence of a bearish pattern developing with an opportunity, like I said, to go down all the way at least to the 200-day moving average, if not a little bit below it, because that's where the gap is, right? Where the top of the gap is. So what we did is we said, okay, well, for February expiration, let's sell the 140 and buy the 145 puts. We sell them from really cheap. This is where we're at here. We can put a half a position size on, and then we can go for a 5-to-1 risk reward scenario in the worst case scenario. And there's my maximum gain inside of one standard deviation. Let's actually go to February expiration. Inside of one standard deviation. So if we get going, great. If we don't, if we pull up a little bit and this pops out, we hold support here, then we can close off with a couple $100 loss and end up with about a 10-to-1 risk reward ratio. So a really good setup, especially with the lack of volume that's in this area that can really make it easy to go down towards that 140 level. And so you notice I've already in the trade, and you might be thinking, well, why did you already get in the trade before you ever did a video for it? Well, because our premium subscribers get access to that trade before the market closes, whether it's through the Market Outlook live videos, which we didn't do on Friday because I was out of town, but I did put out our Telegram. We use Telegram for our real-time trade alerts, for our trade alert system. So I did send out that trade alert system to all of our premium subscribers using that Telegram service. So one of the benefits, and again, we're up for renewal. A lot of our original premium subscribers are up for renewal there, and you should have your email. We had quite a much bigger number than I expected renew right off the bat. So if you didn't get your email, we've had some people say they didn't get it. If you didn't get your email, please let me know, and I can make sure you get the link that's very specific for you. It's a unique link that only works for you. for our original premium subscribers to be able to now renew, that we are heading in to the end of our first 3-year window, which is such a great thing. Didn't, you think, you hear stories about, small businesses are hard to get going, but, we've made it through 3 years and plan on this continuing going from here now that we're established and we're set. As always, thank you all very much for watching. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. So post any threads there, reply to any threads, and let's keep this conversation going. As always, have a great rest of your holiday weekend, everybody. Subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video. Have a great one, and we'll see you all next week.